I am Ivan Oberon. I'm the West Coast Regional Sales Director for National Real Estate Insurance Group. Also the co-founder of Steadfast Capital LLC. I am very grateful to be here to talk to you about a subject that I think we're all going to agree needs to be much better understood. I don't know anything about that legal stuff, but I think insurance issues for real estate investors is near and dear to my heart because I am an investor. And I do stand before you as one of your greatest advocates because I am an active investor. I've been flipping houses for many years, and now I focus primarily on cash flow, just like many of you, because I think that's the future, and I thought that was the best thing to do. So today we're going to talk about what we've identified as 13 insurance myths for the real estate investor. Does that sound like a good idea? Yeah. Okay, so the first myth is that insurance is exclusive of estate tax and financial planning. And I see this on the social media websites, like questions being asked like, hey, I have insurance, so I don't need an LLC, or vice versa. And you already know, because what Brett told you, this is a lie, it's a myth, and you need a good asset protection strategy in place first. Insurance is not a panacea. It's not going to cover everything. The easiest way to think about it is figure insurance is your archer on your tower, right? It picks off all the stuff that tries to come at you. Asset protection and your attorneys and all that kind of stuff, estate planning, those are your moat and your castle walls that are protecting the stuff. I know, Brett totally stole my castle theme, right? It's just like I saw that, you're like, man, this castle thing again. So that's the way it is. It should not be the primary foundation. It should be incorporated into everything that you're doing. And we're going to kind of talk about how to do it right here. How many of you here have done a subject to deal? Purchase of property, subject to. All right, so we're gonna go into this just a little bit for your benefit in case anybody else gets into this in the future. But being named as an additional insured on the existing homeowner's insurance policy is fine. That's the way a lot of people do it. They think, well, it's easy enough. There's two scenarios really. It's easy enough to just keep the existing homeowner's policy in place and have them add me as additional insured. She's shaking her head. She's smarter than the average cookie. So there's a couple of issues that come up here. One, because you're the additional insured, and now that property is no longer owner occupied, there's been a significant change in the exposure, right? So what does that enable the insurance company to do in the event of a claim? Deny the claim. Right? And if by some miracle the insurance company actually pays, who's going to get paid? Not you. You're not going to get a dime of that because you're not listed as the first name insured. Now the second scenario, somebody got a little bit smarter and said, I'm going to keep that homeowner's policy in place. And why do you think that they might do that? What's the biggest concern on a subject to deal that comes up sometimes? Due on sale clause. Right? We don't want that due on sale clause being called, right? And the note being called due. So we're going to keep the existing policy in place, and we're going to take our own insurance policy out and list ourselves as named insured. So that'll be better. The problem here is that both of those insurance companies are going to have what's called an excess clause in their contracts. And that means that they will only pay in excess of whatever other insurance is already in place. So if both of them have that clause, how long do you think it's going to take for you to get paid? Right? It probably won't happen. So what's the right way to do it? What we do is we write a landlord-type commercial policy listing you as the first named insured, the owner or the seller as the additional insured, and the bank as the mortgagee. And in 15 years of doing that, we've never had a note called because it's the right process. The bank still sees that that person is still an interest in the policy. But yeah, anybody that does first trust deed investments, maybe you're buying properties, but maybe you're doing a first trust deed, get a little bit better return or something like that. Well, you need to be listed as mortgagee because you're Wells Fargo. That's all you are. You hold that first trust deed. So mortgagee, not additional insured. All right, number 3, buying a property in your personal name and using your homeowner's policy liability is fine. Anybody think this is true? So there's some issues here that we have to address. Because what Brett was saying, sometimes it makes sense to purchase in your personal name, etc. What you have to understand is that the IRS considers anything that generates income for you, like a rental property, a business exposure, a business activity. So you want to make sure that you're keeping your personal activities separate from your business activities, even if they're owned in your personal name, because their activities are different. Now these next two are kind of tie into each other. The personal dwelling fire policy. But what happens is you have an Allstate, and insures your home, insures your autos. Yeah, I bought a rental property. Oh sure, we'll insure that under our personal dwelling fire policy. Problem is that they don't understand that it's a business related activity, and they're going to lump it all under your personal liability. Right? We talked about umbrella policies. Right? You start buying rentals, insuring them under a personal insurance policy. Man, I need an umbrella policy now. I need $1 million. I need $2 million. And we're going to talk about how you separate those two things, because it is important to have your personal liabilities covered. In the event that, Brett could probably tell you a lot of horror stories of somebody driving to school and hitting a bus and killing 3 children, and that's all personal liability, and you should have had $15 million in coverage, right? But you want to keep those things separate. There's always going to be additional excess under your business policy, and here's the umbrella. Having a personal umbrella policy, so I don't need commercial insurance. You do need a personal umbrella policy, but you also need excess business insurance, or commercial insurance as we call it, to protect your business liabilities. In your case, it's all your rental properties. And how much is enough? Right, he says $3 to $5 million because of his activities or his experiences here. I use this rule of thumb. You want to make the insurance company or your liability protection more attractive than your current net worth, which is only you know that, your perceived net worth. Right? How many of you think your perceived net worth is much higher than your actual net worth? In my previous life, I was a regular P&C guy before I got into investing and learned all this cool stuff. And I live in Camarillo, so we have a lot of agriculture out there. So I did a lot of insurance for farmers. And man, you see guys owning 500, 1,000 acres. Their perceived net worth is pretty high. You see 10 rental properties on your portfolio, your perceived net worth is really high. Even if you bought in a really bad area that looked really good on paper, but then you bought it and it actually needed $25,000 in rehab and it wasn't occupied. Not that I've ever seen anybody run into that. But, and the third thing is your potential future net worth. Because Brett talked about, well, how long can they come after you for? They can just keep renewing it every 10 years, right? Maybe there's going to be something juicy that comes along. Maybe you're struggling right now, but you're going to hit down the road. And your potential future net worth through the growing of your assets, and maybe an inheritance, all those different things. So within reason, right, because of the insurance premium, you have to be able to make it reasonable. Within reason, you want to make sure that it's more attractive than those things, so they don't get incentivized to come after you personally. They're going to come after your insurance policy. Does that make sense? Okay, now we're talking now on the personal side. Number 6, a claim that occurred before I owned the property should not affect my rates. Does anybody run into an issue where you bought a property, you run a clue report, but finally there was a loss, and they said, well, we're either not going to insure it, we're going to charge you more. Anybody? Okay. Well, prepare for this to be an issue. It didn't used to be the case. It was always that the losses followed the previous owner. And the insurance company might say, well, we just want to verify that these repairs were adequately done before we place coverage on here, but it's not going to affect you. What's happened now is that insurance companies are using, in certain states especially, not only your credit score, but also the home's previous claims history to determine your premium. So you want to watch out for that and make sure you do business with a company that doesn't operate that way, just to keep your bottom lines down.
How can you check that before you buy your property?
Well, you ask them. You're gonna get a proposal, or they're gonna run these reports through their underwriting process. And the clue report on personal lines, in personal lines companies, and I'm gonna tell you to go away from that, but in personal lines companies, they always run a clue report. Anytime they're gonna do a proposal or something on a property, they'll run that, and then they'll be told, okay, well, you have to charge this, or you have to ask for these things through the underwriting process. So your agent will know. The agent would know. Okay, we're going to spend a little bit of time on this slide. I get this quite a bit. People think that all policies and coverages are created equally, right? So they say, well, I got this quote from so-and-so, and it's the same thing. But they don't look further into it. So we're going to spend time identifying what some of these things are. There are three main policy provisions that a policy is written under. Basic form, which is basically loss settlement provisions, broad form, and special form. And I'm not going to put you to sleep explaining exactly what those things are, but it's pretty easy to understand. If you have the option to go with special or basic, which do you think you might want better? Special. Right? Now that's probably, in most cases, you might choose a special. But as an investor, once you understand what these things are and the type of property that you're buying and different things, it might make sense to go with basic form in some cases. That's where you educate yourself. The main thing to understand about basic form, as far as the differences, besides the fact that there's about a 30% difference in premium, is that the two main things you care about that are excluded in basic, that are included in special, are water damage and theft. Those are probably the two main things you care about. There's a few other things that really don't matter. And the difference between the forms is, one of them is what's called a named peril policy form, which means that they're going to have their list of coverages and they're going to have their list of exclusions. Special is an all perils policy form. And all that means is that as long as it's not on the exclusions list, there's potential for the company to pay out. So that's one of the reasons that it's much, much better. The other two things are actual cash value and replacement cost value. Have you guys heard those terms before? Okay. Do you know the difference between the two? Just the basic differences. One person nods their head. Okay. So it really all it is that actual cash value settles your claim minus your minus depreciation. So whatever the damage is to that particular thing, they're going to go ahead and depreciate it. So say there's a loss to the roof of $100,000, to the house I mean, of $100,000. And they say that because the house is 20 years old and none of these things have ever been updated, well, there's going to be certain things in there that they're going to depreciate based on that timeline, because that useful lifetime has expired by that many years. Replacement cost simply means that they're going to settle the claim without taking depreciation into effect, but of course your deductible still applies. In some cases, it makes sense to insure for actual cash value. In some cases, you're going to go with replacement cost. And every claim, even under the replacement cost, every claim is first settled on an actual cash value basis. And if the claim exceeds what the actual cash value settlement is, then they submit for the true replacement cost for those things. So whether it's in your homeowners, it's going to be things like TV, electronic equipment, furniture, cabinets, all that kind of stuff. They're not going to depreciate it. They're going to give you whatever the full replacement cost value is. And one of the things that you care about probably most as an investor is coinsurance, the coinsurance provision and coinsurance requirement. Has any of your agents talked to you about coinsurance, and do you know what it is? Wow, yeah, it's one of the biggest issues, and one of the ways that insurance companies charge you more premium. And I'm a consumer just like you, so when we created these programs, even though we're tenured insurance guys, we want to keep our premiums down, or at least have the ability to pick and choose the coverages and the structure that we want. So it used to be that, and I know lady in the back, she used to do loans and stuff, so she knows this. A lot of insurance companies used to insure under what's called guaranteed replacement cost basis. So what they were doing is they were guaranteeing that if your house burns down, they're going to replace it pretty much no matter what. As long as here's the coverage that we agreed on, loss happens, it doesn't matter if the construction cost went up or down or whatever it is, we guarantee we're going to do it. Sounds like a pretty good deal. Well, then what happened? Hurricane Hugo and Andrew came about, hit Florida and the Carolinas, and thousands of insured locations were hit. A lot of insurance companies went out of business. A lot of them took a really big hit. So guess what? We still get the requests from mortgagees, guaranteed replacement costs. Well, guess what? It doesn't exist anymore. Not only does that not exist anymore, now they have what's called a coinsurance requirement. And what that means is that when you go, for example, you've gone insurance, the agent comes back and tells you, well, we think it's going to cost this much, let's say $200,000 to rebuild this house. Right? They run a Marshall and Swift, and this is what it's going to take. So the co-insurance requirement, what that stands for is, now we say you got to go for at least $200,000. Our co-insurance requirement is 80% of that, or 90% of that. Some insurance companies will have it be 100% of that. But you're a real estate investor, and you didn't spend $200,000. You got a good deal. You bought it for $100,000. All your invested capital is $100,000, and you know that you could probably rebuild it for $120,000. So you don't want to insure it and pay the extra premium at $160,000 or $180,000 or at $200,000. So you decide you want to insure it for less. Everybody with me so far? So now a claim happens. The insurance company is going to say, okay, how much less did you insure it for? And then they consider that your underinsured value. So let's say you're 30% underinsured based on their stiff-arming, strong-arming co-insurance requirement. Well, thank you very much. Now we're going to pay your claim minus the 30%. That's your co-insurance penalty. You're underinsured 30%, we're going to pay that claim minus 30%, minus your deductible. Make sense? One person shakes their head, no. So the takeaway here is ask your agent about co-insurance, and if possible, work with a company that won't hit you with a co-insurance requirement. Very, very few of them out there. Myth number 8. So as real estate investors, you have to understand there are different types of losses, right? And as an investor, you understand that the insurance premium you pay is what? It's a loss to your business, to your profitability. And the deductible is one of the only ways that you have control of those premiums that you pay. You can choose what kind of deductible you have and mitigate those costs. Especially as your portfolio grows. And it's crazy. People, I still know people, and it only happens on personal lines policies, but $500,000, $1,500 deductibles, that's crazy. The rule of thumb is on this, think about what the minimum claim that you would file and spend the time and get that loss on your history report and go through the trouble of doing all that by filing a claim. Think about what the minimum number that is and at least double it. And that's a pretty good area to keep your deductible at. So there are two different types of things that we talk about as far as self-insuring, right? Property is one of them. And that's one thing that I think a lot of people are most focused on. What if there's a loss to my property? And they don't think about the other side, the liability part, right? The property stuff can be a nuisance, might bend you, right? It'll bother you, or it might bend you. And that's kind of my little loss prevention thing. You use a thing called bother, bend, or break. The things that will bother you, you retain those. Like your deductible, minor claims, that sort of thing, you retain those. The things that will bend you, kind of like, oh man, that's going to hurt for a couple of months. You consider that. You might retain some of that, you might transfer some of that. And then there's the breaks. The breaks are the thing that you always transfer, meaning get insurance on. There's people that self-insure their property altogether. They might have bought a pool of properties, and there's some vacant ones. They're not sure what they're going to do with them. They're going to renovate them, hopefully, and put a tenant in them eventually, but they're more worried about these other things. They're going to self-insure for those $15,000 properties, maybe $20,000 property. But should you ever self-insure the liability piece? Who's comfortable with that? No, never self-insure the liability piece. Even if you're going to own a property for a day or two, get liability on that location. Under our schedule, it costs like $7 for a month for $1 million in liability. Just add the location just for liability, just for a day or two, if that's all you're going to keep it for. Because anything can happen. And as Brett will agree with me on, say you only owned it for 2 days or a week, well, they can come back later on down the road and say something happened during that 2 days or a week that you owned the property and you didn't have coverage, and now you're calling Brett and asking him why he didn't tell you about that. I just told you, so just it's worth it. It's worth it. It's so cheap to do. And then of course there's your claims reporting. You want to make sure that you are very good about keeping your agent or your company informed of everything that happens. And I like to use the auto claim issue, and then we'll lean into how this makes sense. Because how many of you have ever been in a small fender bender, it was your fault, and you decided, you know what, let me take care of that for you. We don't need to file a claim. Has anybody done that? Come on, be honest. There's one honest person. Okay, 3. Okay, 5. There we go. Okay, I've done it too. Okay, it's okay. That's kind of like human nature. Oh man, who wants to deal with that nasty insurance stuff? Is it going to raise my rent, my rates, and what's going to happen? So, on the property side, let's just say you have a great tenant. She's a nice old lady, and you really like her. She always pays rent on time. She doesn't really have any maintenance issues. But she calls you one day and tells you that she got hurt walking up the stairs on the outside of your rental property. You know what? She really doesn't have the money to go to the doctor. So you think to yourself, man, she's a great tenant. You know, I don't want her to leave. I want her to be happy. So no problem, no problem. Just go ahead and go, and I'll take care of it. So you do. Everything's fine. But about a week later, she tells you that, man, she's just in so much pain now.
Oh no.
She needs to go back.
Yeah.
And you start thinking to yourself, oh my gosh, like, what did I get myself into?
Yeah.
This could end up being kind of costly. Yeah, maybe I should report it. Well, before you get a chance to do that, her grandson, who just loves his grandma and is an attorney.
Or knows an attorney.
Very sympathetic to her plight, calls you and says, you know what? I think you better report this to your insurance company. So what's the problem? What's the point I'm getting at? What you've done in trying to pay some of her claim yourself, not reporting it, letting time lapse, is you've kind of handcuffed the insurance company or limited their ability to really defend you and pay your claim. So it's a bad idea. Always report it, even if it's just an incident. Okay, you don't have to file a full-on claim. I did that this week. I have a client in San Luis Obispo who owns a brewery restaurant. One of his employees has cut his hand on a piece of equipment. Not a big deal, it's just first aid medical, not a full-blown claim, but we reported it as an incident. Hey look, this is what's happening, this happened, we'll keep it under wraps. These are the exact details because everything is fresh. Everything is fresh in your mind at the time. You can get all the details, get all the information, and then you did your duty and the insurance company can come and protect you. Alright, so again, this might not apply to a lot of you since you're not flipping houses, but you might buy a property that is going to be a rental, but maybe it needs a little bit of work. Right? That's a possibility. And this is one thing that I hear people talk about a lot. You know, get builder's risk insurance. So that's a big myth. Okay, one thing that you got to know is that builder's risk really is designed for ground up construction. It's not really for your renovations and your little fix-ups and things of that nature. So, but this is what you're told, and so you go and you call your insurance guy and you say, hey, I need builder's risk coverage, and so he goes and he finds it, and he gets you 2 quotes. One's for $3,000 and one's for $2,000. Which one do you think you might take? Maybe the $2,000 one, right? But so you go with that one, but before it's too late, or by the time it's too late, you found out that that $2,000 policy had a 100% co-insurance requirement, or, and I'm getting my terms mixed up, the 100% minimum earned premium. That's a new concept that we're introducing now. And the other one had a 50% minimum earned premium. What do you think that means? A minimum earned premium is something that the insurance company says that we're going to put this policy out here, but we're going to require you to pay at least 25%, 50%, or in some cases 100% of this premium is already earned as soon as the policy goes into force. So you're done with the renovation 3 weeks later, you try to cancel that policy and find out that that $2,000 policy, well, guess what? You have to walk away now from that $2,000 policy or premium because they had 100% minimum earned premium. So the takeaway here is ask. A lot of companies don't have minimum earned premiums, but commercial policies like builder's risk, they will all have at least a 25% minimum earned premium. You got to be aware of that. And I run into that a lot when I have people send me their portfolios and they want to shift coverage because they like the way our program is set up, they like the fact that we understand how to insure them, the ease of use that we have, and all of the different things that we'll get into later. And then I'll look at some of their policies and say, well, we can take these now, but we're going to have to wait on these because they had a 25% or 50% minimum earned premium. And it's not worth it for you to walk away from $1,000. We'll wait until that's either expired or the policy renews. So it's just something for you to be aware of so that you know it's there. Make sense? Okay. I'm not sure if you guys are keeping up your end of the bargain. All right, number 10. Yeah, I was going to let you guys read that first because I think you guys probably have done this. So it's worth it to hire a handyman to do the maintenance on my properties. Many think this is the case. There are many gurus out there who are even telling people, teaching them how to flip houses and telling you, oh, don't worry about how expensive it is to rehab houses. You can hire a handyman, you can do all these different things. Right? So anybody think this is a good idea? Again, it's a liability. Handyman is not going to have certificates of insurance. They're not going to have bonds. They're not going to have these things that you have to require. Okay? And when you require somebody to provide you a certificate of insurance, when you get it, are you done? Oh, okay, this is good. You file it away? Most people do. You call it right. You got to verify it. On that certificate of insurance, the agent's name who is offering that coverage and their contact information will be on there. Call that agent. Make sure it's enforced. Maybe set a reminder to yourself 2 weeks later. Call them again. What do a lot of these contractors do? They'll get the insurance just to get the job, provide you the certificate of insurance, and then they'll cancel it. In some cases, they'll do a flat cancellation so they don't have to pay any premium. Right? You got to verify. It's not enough to just ask for it, but no. Handyman, especially, I mean, with rental properties and self-managing and all that kind of stuff, sometimes it's just easier to get a handyman, but in the end, I don't think it's worth it. Number 11, Brett touched on this a little bit. If I use my personal vehicle to service my properties, my personal auto policy is sufficient. How many of you self-manage your properties? God bless you. Oh my gosh. All right. Hopefully you don't have any aspirations of scaling your portfolio to 100 properties or more. But what if you're managing your property and you're going to go do a service call, maybe you're going to go put in some sod, maybe you're going to go change out a faucet or whatever, and you're doing a run to Home Depot or Lowe's or Sherwin-Williams or whatever, and you get in an accident. What were you doing? What were you in the course of? Were you in the course of business or the course of personal?
Business.
You're in business. So your insurance company can deny that claim. And you'll be amazed to find out that getting one of those autos, especially if you have signage, especially if you do anything like that, right? One of those autos, moving it onto a commercial policy or business policy, in many cases could be less expensive than on your personal auto policy with $1 million in liability. And then of course you have to toe that line, right? Because there's an attorney in the room, I'm going to mention this. Then what? There's a problem. The car just sits there, you can't go buy groceries with it. Can't go pick up your kids from school, because what if something happens then? So it's a fine line, but depending on how much you're doing it, you gotta think about it. Yeah, and I mean, there's a lot of personal insurance companies out there, like Allied and Nationwide and all those companies, that might ask you during the underwriting process, do you have any signage on your car? And if you do, they're gonna be, oh, that's a business exposure. And some of them are getting smarter and asking those questions. And it might seem like a pain in the butt, however, they are doing you a favor. Because they're pointing out that exposure, and the fact that they don't want to insure it because they're not, it's not a business policy, should be a red flag for you that maybe you're doing something that you shouldn't be doing. Number 12. So it's enough to simply require renter's insurance. A lot of you require it, a lot of you don't. The issue is, are you enforcing it? Because you can require it all you want, but if you don't enforce it, when you require it and they have it and they add you as the additional interest on that policy, you will be notified of any changes to that policy as far as whether it's active or not. Just like as a mortgagee, if a policy cancels for non-payment or for any other reason, you get a notification. It's a cancellation notice. So you should always know that, but it's a little too late. You gotta enforce it. And one of the things that I think a lot of you run into is maybe you have a lower end rental, right? You have a property, you know, people that are paying $1,500, $2,000, $2,500 a month in rent are not going to have to be told to get renter's insurance. They're going to already understand that I want to protect my own property because your policy isn't going to do it. So you got to pitch it to them in a way that it's for their benefit, right? It's not for your benefit, it's for their benefit, even though it is for your benefit. But they're going to benefit also. Not only that, they have personal liabilities. So if they get sued because of something that happened, they need that renter's insurance. And personal liability follows you anywhere you go in the world. How many people need that? Right? It doesn't pertain to your house, something happening at your house. If you cut somebody off and they sue you for mental distress, guess what? That's liability. If you go outside of Starbucks and say how crappy their coffee is and their business suffers, well, now they can sue you for libel. Or if you cause bodily injury or property damage to somebody else in somebody else's house or while you're on vacation in Europe, those are personal liabilities that are all covered under your personal liability policies and your umbrella policies, your personal umbrella policies. Same thing with that tenant. Their personal liability under that renter's policy follows them anywhere they go in the world. Something happens in their house, it's covered. Something happens somewhere else, it's covered. And did you know that more than 60% of property claims are caused by tenants? So 60% of any claim that might happen on your property is going to be caused by your tenant. Most renters policies out there will have a provision for about $300,000 for tenant-caused damages. And so what does that do? It prevents you from having to file a claim against your policy and going through that process and then getting a claim against your policy as well. But it's there as a secondary defense. You always want them to be the first line of defense. Okay. 13. Cheaper is always better. Is that true? No. Maybe. Sometimes. But what you're looking for is a combination of the right coverage, ease of use, combination of products, ability to scale your business, everything that equates to the overall best value for what you're getting. Not just cheaper. I mean, we all know that cheaper isn't necessarily better, right? You wouldn't necessarily buy a cheaper pair of shoes or cheaper, whoever eats organic food. I mean, you're buying it for the right reason, and you're not going to pay what you pay for all that food with all the chemicals and everything else. I mean, cheaper is not always better. Sometimes you can get some comparisons where they are really equal, and of course you're going to go with the one that's more affordable. But in many cases, it's very difficult, especially in this industry, to do a true apples to apples comparison. Sometimes you can save money, but cheaper is not always better.